to lesson 2. This is the lesson on the main principles of Romanian tax system. In Romania, the tax regulatory framework is established mainly by the Fiscal Code together with the Fiscal Procedure Code. For your exam purposes, all this material is based on the tax laws as issued at 30 September last year. All taxes and duties applicable in Romania are based on the following main principle. Neutrality. This means that all tax requirements are not dependent on the different category of investors or funds or type of property. By example, a Romanian company pays corporate income tax of 16% of taxable profit, no matter if the shareholders are Romanian or foreigners, or if they are individuals or other companies, or even the Romanian state. Clarity. Suppose that all tax requirements are straight and there are no arbitrary interpretation. Deadlines, payable amounts, payments options are clearly stated. Equity. For each taxpayer, each tax is depending on income or wealth. Equity means that for each taxpayer, each tax is depending on income or wealth. The equity of a tax system concerns whether the tax burden is distributed fairly among the population. The idea is that taxpayers with a greater ability to pay taxes should pay larger amounts. Efficiency is achieved by maintaining the stability of government income from one tax year to another. An efficient tax system is that which manages to healthily distribute the wealth between the individuals of a nation. And the last principle, predictability. According to our tax law, taxes and contributions are freezed for at least 1 year. Now, about the tax avoidance and tax evasion. Essentially, the difference between the avoidance and evasion is legality. Tax avoidance is legally exploiting the tax system to reduce current or future tax liability by means not intended by the tax authorities. It often involves artificial transactions that are meant to produce a tax advantage. To give you some example, tax avoidance means tax deduction or changing one's business structure through incorporation or outsourcing. Tax avoidance is not the same as tax planning or mitigation. Tax planning is conduct which reduces tax liability without going against the intention of tax authorities. For instance, through sponsorship or investments in certain assets which qualify for tax relief. Other examples of mitigation include payments into a supplementary pension scheme or subscription for supplementary health insurance for one's employees. Although tax avoidance does not mean breaking the law, the action itself is frustrating for tax authorities and usually results in changes of tax laws. Tax avoidance may easily become tax evasion. Tax evasion means to escape paying taxes illegally. This is usually when a person misrepresents or conceals the true state of their affairs to tax authorities. For example, dishonest tax reporting. Also, tax evasion is a deliberate and illegal postpone of tax liability. Please remember, tax evasion is punished by law with fees and/or even imprisonment. Okay, now let's imagine you are in the exam. How would you answer the question in the to-do section below? Try it and see you next in lesson 3.